Hello, this is Mike Swanson. I run the website wallstreetwindow.com, and the odds are you're watching this video because you got an email from me telling you that it's up. Now, if you're not on the email list, scroll below the video on YouTube in the description, and there's a link for you to join it. There's so many things happening in the markets right now. The volatility is increasing, and I got one of the smartest traders I know to talk about what's going on, an expert in technical analysis. That's Matthew Frailey, who runs the website breakpointtrades.com. How you doing today, Matt?
Great, Mike. Yeah, thanks for that introduction. I try. And Mike and I have known each other a long time, and over 20 years. That's where.
Yeah.
I think your original website was Timing Wall Street, wasn't it?
Yeah.
Way back in the day, I used to print out Mike's stuff back in 1999, and so we've known each other a long time. And Breakpoint Trades here is I started that in 2003, so coming up around 19 years. So it's quite a long time at this point.
So we've been around for a long time, and we have seen market cycles. In fact, I put in something out Monday that I think there are things happening in the markets I've only seen twice, and in gold too. But you got the charts, your own analysis, and to share with us too. But I'm just saying this is a critical moment, I believe.
Yeah, Mike and I have been through the 2000 tech bubble. We've been through the 2008, and there's so many new traders who haven't even been through either of those, right? There's a lot of the recent people, maybe they've only been through the February, March 2020 correction. And that's one thing I want to discuss real briefly, is because, CNBC would tell you that was a bear market. But, the discussion you and I had on the phone the other day was, to me, bear markets are not just a percentage decline. CNBC would tell you anything over 20% is a bear market. But to me, bear markets are about psychology, about wearing you out, about a change in leadership. And the February, March 2020, while very deep, something like 30% for the S&P, it was over in a month. And so, a lot of these YOLO investors, you only live once, these Robin Hooders, they were able to just, if they weren't margined to heck and called out of their positions, they were able to just ride that out, and they were back to break even in a couple months. To me, that's not a bear market. A bear market is something that, in time, it would last a year, maybe a year and a half, 2 years. And also just the time period would basically discourage a lot of those folks, and I think there's so many what I call not unsophisticated traders out there. A lot of these young guys, you see them on YouTube, they think they got it all figured out. You buy every dip, it always goes up, it's easy. And, I've just been in trading and investing long enough and read enough books that usually the market doesn't let the pawns make all the money. And eventually he's got to teach them a hard lesson. We were all once pawns too, and you have to go through these hard lessons when you kind of learn to manage your risk better. And you know what I mean, Mike?
Oh, sure.
And I think we almost, just from that standpoint, need a bear market just to kind of wipe out some of that excess speculation. But we're seeing there's a lot of concerning things right now. We have the Ukraine stuff. Now, I think for the market, that's it's something it's concerned with in the short term. But what I think is the bigger thing with the market is all the debt, the Fed, and everything else. I think the Ukraine is short term.
Well, I've been telling people, I believe the biggest trend right now, one of the biggest trends is inflation.
Yep.
And inflation, energy stocks or oil prices have been going up for 2 years.
Yep.
And now there's, the news is linking that to Ukraine, recently, and they're linking inflation to Ukraine. And these were going on last year and the year before. These are underlying trends. And look at that chart you got right there.
So yeah, this is the CRB to the S&P. Now the CRB is a composite of multiple commodities: energy, agriculture, metals, and S&P has outperformed. That's the ratio, the CRB divided by the S&P. So you can see it underperforming all these years. But you can see this kind of rounded bottom started occurring in 2020, 21. And, you could see it I like the moving average ribbons here too. So what I use there is the EMAs, 9, 20, 34, 50. You could see where the ribbon was bearishly stacked. When they pinch here, you get resumptions in the trend, but you can see what's been happening here with along the ratio. It's wanting to curl up. You can see the ribbons are starting to flip here, and you can see how they want to curl up here. So if this were to begin some sort of this ratio, it just looks like it's, you and I a long time ago, we read I think probably the first technical analysis book I read was Stan Weinstein's Profiting in Bull and Bear Markets. I know you've done things about it, but he talks about these basing patterns, and this ratio has this multi-year basing pattern, where it looks like it could just start launching out of this, right? And so a lot of commodities like energy, a lot of the ags started rallying last year, but man, I mean, this ratio looks like it could have, start a multi-year uptrend, doesn't it?
Yeah, and I don't want to keep interrupting you due to time, but I do want to make one key point I want to make is what you said before about bear markets aren't simply like a fast drop and then come back.
Yep.
It's a psychological thing where people give up or they no longer believe that it's money is to be made in that market. And then that's basically what happened with commodities. That ratio going down from 2011 to 2020, what that meant was that commodities were underperforming the stock market for 10 years or 9 years. And almost everyone out there stopped paying complete attention to them. Few people trade them, few people own them. Bitcoin was more interesting to people. Marijuana stocks more interesting to people. And still, very few people interested in commodities. And that's the time of this underperformance in a bear market in commodities caused that disinterest.
Yep.
And, so there's a big time factor in this. And now it looks like the things are going to change and commodities are going to outperform. You complete that pattern there.
I mean, it really looks like a Stan Weinstein base to me.
Yeah.
It really does. And, gold is the one that hasn't, like, the other commodities all started participating last year. So the CRB was up 44% last year. The S&P was up 27%. So it did outperform the S&P last year. Now, gold is the one that, didn't participate. But if you look at the ratio here, you look at your moving average ribbons, it also now looks like you can see it's flattened. It's starting to, whenever the ribbons are all tightly wound, that's when your energy is bent. That's when you typically get your reversals and you can get a strong move out of it. And again, this isn't going to be a gold newsletter here, but I'll show you the gold weekly. So the gold weekly has been forming this big coil, though, your subscribers follow technicals, these coiled patterns can produce big moves. And so it's been consolidating since this 2020 area. Moving average ribbons are compressed. Everything's ready to launch here. I know you follow the GDX GLD ratio. What we found over the years is the metal does better when the stocks are leading. And so the ratio here is curled up. That's a positive. And so everything's really set up here. The only thing I worry about short term is how much of these last 2 weeks have been baked in with this Ukraine stuff. But if it just pulls back or a little bit, it holds above this coil broken trend line. It's great, So but one last thing on the moving average ribbons, I just want to show you guys is, again, it's where they pinch here. That's when you get your big moves like this. When they get too wide, that's when you get your kind of reversals in your trend. Everything's tightly wound here and they're just starting to go. So the gold area looks decent. There's one of the GOLD Barrick. It also had a fractal, so it had a beautiful coil that it's busted out of. Short term, maybe a little overbought, but I mean, weekly looks great. Ratio, Barrick Gold to GLD looks great. So again, I'm not going to go over a bunch of individual stocks, but this area, looks like it, using the corny phrase, could be ready to join I think gold's is joining the commodity bull market, whereas the other commodities started rallying last year. I think gold is finally going to have its due. Just since Mike and I want to keep this, we don't make this too long. I'm just going to briefly go through some of these charts. So regarding the general market, the one thing obviously a lot of us are following is this yield curve, 10-year divided by the 2-year. And boy, so you can see on the ratio here, since 2021, how quickly this ratio has fallen. This is where you're inverted. It's not that far away. So I do believe this is going to end up going inverted sometime this year. It's usually when it gets this far down, you're kind of destined for it.
Right.
It's interesting, Mike, because it actually briefly went inverted there in late 2019.
Yeah.
Before the pandemic.
Yeah,
I'm not saying it predicted the pandemic, but it's kind of interesting how that happened. But that's something I'm keeping an eye on. On the market, what started worrying me last year, and I started seeing warning signs as far back as July.
Yeah.
So this chart here is the NASDAQ, and there's a few indicators on here, but let's ignore this one. Let's just look at this simple one. This is the percentage of stocks above the 200-day moving average. So it fell below 50% back here in July, and the NASDAQ was at highs. And when I looked back at the past, usually when the NASDAQ was at highs, the percentage of stocks above the 200-day moving average would be like 70, 80%. So it went below 50 here. It never recovered. It went down. In fact, in November, when you made a new high here, it was down at like low 30%. So you had this stealth bear market starting to go on under the surface here, and way before it topped out. So, some other things. This is the NASDAQ. Here's one thing I've also been talking about since December. So this is it's kind of a breadth indicator. It's the new 52-week highs, 52-week lows. And at the bottom here is the difference. It's the 52-week highs minus the lows. And so obviously when there's more 52-week lows, it's going to be negative, right? So it started going negative back here in November, despite that we were at highs, and it's never recovered. But one thing I noticed when I look back at the past is during bear markets, 2000, 2008, when this indicator went negative, if it stays negative, you're usually in some sort of bear market. You can see 2008 here. It just, the 52-week highs minus the lows just stayed below zero. So there was more the whole time. And so that's why I told people is that in order for the market really to recover and be healthy, you needed to see this go back above zero and stay. I talked about this back in December, and it never has. And so this is, to me, this is a worrisome. Some other things we talked about, all these bear markets under the surface. I think, back like in late December, I remember there was a stat I saw that 40% of the stocks in the NASDAQ were down 40%. So there's a lot of these, we call these Christmas trees. So I decorated this one. It's an example, Peloton, but you could throw in anything. You could throw in Zoom, PayPal, Snapchat, whatever. And you got these stocks that have just had these huge runs, and they've come all the way down, like a Christmas tree, right? Basically like a mountain, all the way up, all the way down. Actually, I know quite a few investors. I know there's a couple professional guys I consult with who have stocks like this, and they wrote them all the way down. They're still in the things. But like this was happening when the NASDAQ was still way up near the highs.
Yeah,
you had all this
you
had all this under the surface. So it's kind of like a cancer kind of eating away under the surface, where you don't see it on the indexes because they're heavily weighted, right?
Well, what about it too is a lot of those stocks have charts like that, Zoom, Square, many. But then just the other week, Facebook blew up 20%, Netflix blew up 20%,
exactly,
and those are the leaders. Yeah.
So usually we talk about the generals that are the last to get taken out and shot, and but like let's say we're in some sort of bear markets. There's the S&P that's the 2009 lows. Let's say this is some sort of long bull market. Usually bear markets are some sort of, retracement of a previous bull. So minimum would be, say, 38%. That would be around 3,200, but it could be 30%, it could be 61%. So again, this would be something, if we do have a decent high in here, that would occur over time. I mean, don't expect it to go straight down. I mean, it's gonna stair step. I think eventually we'll have a decent rally, form a lower high. So, which I'll go over in a second. Just some other things I look at. These are just some obvious things. So what this is the monthly chart of the S&P. These are two moving average EMAs that I find useful, 8 and a 13. While they're not perfect, you could see overall they've done a pretty good job about catching the bull markets, bear markets, bull markets. Like in 2008, it crossed in January. So none of these crossed either since that time. And I don't care. Look, it's so far away from crossing. But what I'm kind of pointing out here is when it gets too wide, look how wide they are. So it's at minimum due for some sort of sideways.
I want to point out to people, there's a lot of people, honestly, they watch, especially that watch on YouTube, that are new to the markets. And these indicators that you're talking about, all the ones with gold, with the one you just showed us with the S&P, all these indicators, these are charts, these are indicators that only trigger every couple of years.
Yeah.
But most people, they got their Robinhood app, they see the daily gyration, they're going to read the daily headline tomorrow and think that's linked to the market action. But this is all very short-term information they're looking at. Most of it's noise. And these things you're showing us with the new highs and new lows, these are long-term indicators that are extremely significant.
Yep. Yeah. And so here's another one. Now this is, you don't follow these as much as I do, but I do. So like on all my charts, you'll see these moving average ribbons. So the way the ribbons, I like to think of them, they go through periods of contraction, expansion. When they get too wide, see how this is a monthly chart. Look how wide this thing is. So these are comments I had back in November that it may take a year or two for this to unwind and say, they're just they're too wide here. They need to come these ribbons, they go through, they get it wide, they pinch, they get wide, they pinch. So like back here in 2015 to 16, they actually got pretty wide there, and it took a year for this to kind of unwind. And look how wide this is. I mean, I could see this taking, a couple of years for this to kind of normalize. It's just, again, this is the kind of more bigger picture stuff.
And this is the NASDAQ, right?
That was the S&P. Now
S&P, okay.
So that's the S&P daily. I'll just, S&P daily. What I'm kind of wondering here is, clearly we broke those trends here in January. We formed a lower high here so far. Like, if we do rally up again, let's say we kind of hold in here and rally up again, we could still form a right shoulder. That would be something for people to watch, kind of a head and shoulder. These are the moving average ribbons I'll use. You can see how they went bearishly stacked. Let's see, high yield corporate, that's been something that's been really weakening on the market. HYG is the high yield bonds. And, they've been extremely correlated with the market, something like 95%. But we started really seeing the bonds, just high yield corporate, really under correlate the S&P. So that was kind of a little warning. Some of these other indexes, the Russell, it's been underperforming. This is a weekly chart, broke its support, back tested it as resistance. There's really no good support down in here until you get way down into here. I'm just trying to go through these charts a little quickly. Qs, here's the NASDAQ. And that's the problem with the NASDAQ. You got 8 stocks of the triple Qs that represent 52% of the movement. So, Microsoft and Apple, it's 20%, 22% of the thing. So that's why you could have all this damage under the surface, but not see it on the indexes until those generals get taken out. But the NASDAQ, you could see clearly broke this trend line. Here's your nice moving average ribbon. You could see it flipped bearish here. Stalled at the 200-day moving average recently here on that rally, lower high. This could be another target area down here. And then down here could be some targets over time. Just some things I'm looking at. But, last thing I'll just cover here, some of those stocks you mentioned, like Facebook. So some of your readers may follow Elliott Wave. I could see perhaps the 5th wave high here, and I could see maybe something like this occurring over time. Facebook's got taken to the woodshed, maybe a little bit lower, rally, form a lower high, and then decline. Look, this is a monthly chart. So this is 2022, it's 2023. Maybe it could end up down there eventually. Intel is a monthly chart. This kind of almost has a little slanted head and shoulder look. Break this, you could come down into this range. So Apple, my last chart here, I think, everyone should, and I think you'd agree, everyone, no matter your time frame, is for trading, investing, you should have some sort of exit plan. Because as I said, there's a lot of these folks that, those Christmas tree patterns, like I showed you, Square and Peloton and all that, these guys I know bought those really well. They went up 300, 400, 500%. And then they've ridden them all the way down because they don't have any exit plan. So even Apple, someone always tells me Apple always goes up. Well, that's been the case, but you never know. If we were to have a bear market, this leadership could change. You still want some sort of exit plan to your strategy. So what I'm showing here is a weekly chart. All right. The dotted blue lines, that is your higher lows. So, if you're a longer term guy and you don't want to be stopping out on noise, you're worried about taxes, just set a stop at the higher lows. So by doing this, you could see the higher lows would have kept you in this trend for the last 3 years quite well, consistently raising your stop. So your next stop would be right here. It gives you some sort of exit plan just in case, you know what I mean? So I think everyone should at least have something like that, even with things like Apple that people consider untouchable with the market, because you never know.
Well, honestly, it's just my opinion, but I think if I owned Facebook and these, Facebook, just sell them and I'd start to make them on.
I agree. Facebook's done, Netflix is done, Apple hasn't. This general hasn't been. This general hasn't been shot yet.
Right.
But if you go through a bear market, it will get shot. Yeah. He's not going to be like, one of those.
It may not die.
Right. But he won't be like one of those kung fu movies where you see the one guy and he's battling the whole army by himself. Apple won't be it won't be to do that. It'll get hit too. So, no, I mean, here's my biggest concern with the market. And I could concern this back in 2008, but bear markets we can handle. What I don't want to see, and what none of us should want to see, is we don't want to see like a collapse of the system. That's what I worry about sometimes in the back of my mind. They have so much debt built up. What if things really unraveled? You know what I mean? So that's the only thing I always have in the back of my mind. But or we get some hyperinflation, we get some, who knows? So so at the worst, let's just hope we get some sort of bear market, because we can handle that. We can be in the right sectors. We don't want it as an unraveling of like the financial system or some crazy stuff. So yeah, World War III's, all that, you know what I mean? So
yeah, well, I mean, the one thing about it is when they're like now with the news about Russia and Ukraine, anytime there's geopolitical news, it's the media. I mean, war isn't good, but it's not going to be World War III, and they're going to harp on it, and make it, appear to be bigger than it really is. And the stock market declines are like that too. I mean, bear markets are part of the markets. I mean, they happen. They're not the end of the world, but they are if you're on margin or something.
Well, and also usually what I've always seen all over the years with these geopolitical events, the market's a little nervous in it, and then it always ends up resolving up anyway. So again, I don't see that as the issue with the markets. To me, that's short term. What I think what the bigger things I see are, with the Fed, they're going to try to change their, might be on a tightening cycle. The yield curves, that looks like we're in for that trend change where commodities will probably outperform the general market. To me, that's what's more important, not, this Ukraine stuff. To me, that's short term and it'll be resolved. So, yeah.
Well, it's going to be an interesting week. And I think, I would just reiterate, it's going to be, we're seeing market volatility, period. And headlines are used to explain it. But I think these charts that you show, it's the long-term indicators.
Yep.
That only signal every several years that people need to really take seriously, because it's very significant. These things don't do this that often. I mean, those ratios of commodities and that's
oh yeah,
100. You have to go back to 2002, I think, to see a similar turn, perhaps. Bullish. They turned down in 2011. So.
And one thing, Mike, usually what do you see in beginning of bear markets? You see greatly increased volatility, and we've definitely been seeing that. So
well, the VIX, in bull markets, it goes to above 30 and goes back down and doesn't get above 30 for 6 months, sometimes over a year, and it's been above 30 like 3 or 4 times, I think, since
last thing I'll cover. If any of your subscribers want some links to these charts, I can provide them so that you can follow these on your own. So like this is a neat chart. It'll update daily on its own, and these are some neat charts that I can just provide the chart URLs. So
so if people want to get more information from you, just go to your website, I assume, breakpointtrades.com.
Yep.
Okay.
Yep. Perfect.
Well, thanks for taking the time to talk to me and everyone else.
All right, Mac, and have a good trip. And all right, thank you, everyone. Take care.